Before we dive in, remember, we are not financial advisors and you have to do your own research. Now, on to the business of the day. We're taking an in-depth look at the investment face-off, 10 ways stocks and cryptos stand apart. It's crucial to comprehend the distinctions between these two investment avenues, as it can make a world of difference to your portfolio. So, are you ready to discover the unique characteristics of stocks and cryptos? Let's get started. First, let's talk about the age of these assets. Stocks have been a part of our financial landscape for centuries. Their long-standing history has given them a sense of stability and predictability. They've weathered numerous economic cycles, market crashes, and periods of inflation. We have substantial data to analyze trends, forecast future performance, and make informed decisions based on historical patterns. On the other hand, cryptocurrencies are the new kids on the block, having only emerged in the last decade or so. They bring with them a sense of novelty and innovation, but also a level of unpredictability. With a shorter track record, we have less data to base our predictions on. This lack of historical context can make cryptos more volatile and risky. So, whether you're drawn to the tried and true nature of stocks or the exciting potential of cryptos, it's clear that the age of the asset is a significant factor in understanding the differences between stocks and cryptos. Next up is regulation and oversight. Now, stocks are under the watchful eyes of governmental bodies. In the United States, for example, the Securities and Exchange Commission is tasked with protecting investors, maintaining fair markets, and facilitating capital formation. This heavy regulation provides a certain level of security for investors. On the other hand, cryptocurrencies operate largely outside of traditional financial systems. They are underpinned by decentralized peer-to-peer networks, meaning no central authority can exercise control over them. This lack of regulation can be both a blessing and a curse. On the positive side, it allows for greater freedom and flexibility. However, it also opens the door to potential risks and uncertainties. So, whether you prefer the relative security of stocks or the wild frontier of cryptocurrencies, it's clear that the level of regulation and oversight is a major factor to consider. This difference in regulation can greatly affect your investment strategy. Now, let's discuss accessibility and entry barriers. When it comes to traditional stocks, one must have a brokerage account to trade. This often involves paperwork, identity verification, and sometimes even a minimum deposit. It's a process that can take time and requires a certain level of financial knowledge. On the other hand, cryptocurrencies are a different beast altogether. They can be bought and sold by anyone, anywhere, and at any time, as long as they have an internet connection. This democratization of finance is a game changer, allowing individuals from all walks of life to invest, even if they have only a few dollars to spare. Yet, it's worth noting that this ease of access can also lead to increased risk, as crypto markets are notoriously volatile and lack the regulatory oversight of traditional stock markets. So, accessibility and entry barriers are another key difference between stocks and cryptos. Volatility, a word that often scares investors. It's the heart-stopping roller coaster ride of prices that can make or break your financial future. In the world of investments, cryptos and stocks are two different beasts. Cryptocurrencies, the new kid on the block, are known for their high volatility. A single tweet or a sudden shift in market sentiment can send crypto prices soaring or plummeting. On the other hand, stocks, the tried and true investment vehicle, exhibit relative stability. Sure, they have their ups and downs, but these fluctuations are usually less drastic and more predictable. A company's performance, economic indicators, and market trends play a significant role in shaping stock prices. So, when comparing the two, cryptos offer the allure of high returns at the risk of significant losses, while stocks provide gradual and steady growth. This difference in volatility is a major factor to consider when deciding between stocks and cryptos. Dividends and profit sharing, an appealing aspect of stocks. Let's delve into this. When you buy stocks, you're essentially purchasing a piece of a company. As the company performs well and earns profits, they often distribute a portion of these earnings back to the shareholders in the form of dividends. This is a way for you to generate passive income simply for owning the stock. On the flip side, cryptocurrencies don't usually provide dividends or profit sharing. When you buy a crypto, you're buying a digital asset, not a part of a company. The value of your crypto can increase, indeed, sometimes significantly. But typically, the only way you'll make money is when you sell it for more than you paid for it. Profit sharing and dividends can be a consistent source of income, even when the market is down. So, if you're looking for a passive income stream, stocks may be more appealing. Potential for growth, a key consideration for any investor. When we talk about growth potential, the world of crypto can't be overlooked. Yes, stocks have a proven track record of slow and steady growth over time. Companies grow, economies expand, and stock prices tend to rise, albeit gradually. But then, there's the allure of cryptocurrencies. Their growth can be nothing short of meteoric. Remember when Bitcoin was worth mere pennies? Today it's valued at thousands of dollars. It's a roller coaster ride, and the highs can be dizzying. Of course, it's not all sunshine and rainbows. The lows can be deep and the risks are substantial. Yet for those with an appetite for risk, the potential rewards can be enormous. From startups to giants, from tokens to coins, the crypto market offers opportunities that traditional stocks simply can't match. This potential for explosive growth is one of the main attractions of cryptos. Tangibility, a difference you can literally feel. Now, let's delve into the realm of the touchable, the palpable, the tangible. When you own a stock, you're essentially buying a piece of a physical company. You're investing in concrete assets, offices, machinery, products, and the workforce that brings it all to life. This tangible nature of stocks offers a sense of security and familiarity. On the other hand, cryptocurrencies exist in an entirely different dimension. They are wholly digital, residing in the ethereal realm of the internet. When you invest in a cryptocurrency, you're buying into a complex algorithm, a digital asset that you can't touch or see beyond the numbers on a screen. This intangible nature can be thrilling for some, while disconcerting for others. However, it's important to remember that both stocks and cryptocurrencies carry inherent risks and rewards. So the tangibility of the asset is another factor to consider. Let's talk about supply. In the world of investments, supply plays a critical role in determining the value of a particular asset. Take stocks, for example. Companies can increase the supply of their stocks by doing things like splits and additional offerings. This can dilute the value of individual shares, but it can also make the stock more accessible to a wider pool of potential investors. Now, contrast that with cryptocurrencies. For most cryptos, the supply is not flexible. It's fixed. That means there's a set number of coins that will ever exist. This scarcity can drive up the value of individual coins, especially when demand is high. But it can also lead to extreme price volatility, as we've seen with Bitcoin and other popular cryptocurrencies. So, supply is another key difference between stocks and cryptos. It's a factor that can significantly impact the potential returns on your investment and the risks involved. So keep that in mind while making your investment decisions. We've covered a lot of ground today. In our journey through the world of investments, we've explored the age-old realm of stocks and the new frontier of cryptocurrencies. We've seen how the age of these assets affects their stability and reliability, with stocks having a long track record and cryptos being the new kids on the block. Navigating through the waters of regulation and oversight, we've realized the dichotomy. Stocks are heavily regulated, offering investors a safety net, while cryptocurrencies operate in a largely unregulated space, offering both risks and rewards. We've tackled the issues of accessibility and entry barriers, discussing how stocks and cryptos have different gateways for potential investors. Cryptos offer a low entry barrier, while stocks might require a bit more capital up front. The roller coaster of volatility has been a thrilling ride. Cryptocurrencies, with their extreme price swings, offer high-risk, high-reward scenarios, whereas stocks tend to be more stable, but with slower growth. We've delved into dividends and profit sharing, highlighting that stocks often provide these benefits, whereas cryptos generally do not. Yet the potential for growth in both cannot be ignored. The tangibility factor brought us back to reality, reminding us that stocks represent a piece of a real-world company, while cryptos are entirely digital. Finally, we've examined the supply aspect, where stocks can be limitless, but most cryptos have a capped supply. Thanks for watching. Be sure to like, subscribe, and hit the bell notification so you'll get updates when we upload a new video.